Bank Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajiv Ahuja, Interim Managing Director and CEO of RBL Bank. Thank you, and over to you, Mr. Ahuja.
Thank you so much. Good evening, ladies and gentlemen, and thank you for joining us for a discussion on RBL Bank's financial results for the fourth quarter of financial year 22. I hope you and your families have been safe and in good health. I am, as always, joined on this call by other members of our management team, who along with me will address any questions that you might have. We are sharing a little bit more background on Q4 considering the issues of late December 2021. On deposits and liquidity, as you're aware, we had started stabilizing our deposits by end January. That's when we spoke last. And since then, have not only added to the deposits, but also kept improving the retail composition. Our overall deposits increased to about 79,000 crores as of March 31. While the large deposit accretion over these 3 months did happen because of deposit flows from all segments, but even on this larger base, we were able to improve the retail LCR and CASA compared to December 31, 2021. And as we progress during financial year 23, we are confident of continuing to walk on this path of increasing granularity in deposits with a larger proportion of incremental deposits coming from retail. And given our surplus liquidity, we may not increase the overall deposit levels by a big amount. On advances, as you can appreciate, we took a little conservative stand as we first wanted to stabilize the deposits and then look at a growth in advances. This meaningfully commenced in early March, and as you can ascertain, most of the growth came from our wholesale segment, but we did manage to stabilize the overall retail segment too, which had faced depletion in the previous quarters. And as we look at financial year 23, retail will be back on the growth track, while we will look to consolidate our wholesale segment advances with a focus on profitability. We'll talk a lot more about it when Harjeet picks up his section. On provisioning, I think this is something we have been guiding you in the previous quarter as well. We have continued to strengthen our balance sheet, taken accelerated provisioning, materially added to our provision coverage ratio, and are confident in saying that we are adequately provided on both wholesale and retail portfolios, with the provisions largely reflecting the expected loss in the NPA and the restructured book. We are therefore now at a point where, given the trends we are seeing in the recovery and resolution levels and the general external environment, we can say confidently that we are well provided and are entering financial year 23 on a solid footing on asset quality and provisioning. Profitability has been better again in this quarter, and this will improve further in the coming quarters as our interest earning assets increase and the composition of retail grows up. On capital, we have sequentially improved our capital ratios, wherein total capital has gone up from 16.58% as at December end to 16.82 as of March 22. Further, you would have seen our announcement of raising $100 million of Tier 2 capital, which will be completed in the next few days, improving our CRAR further by approximately 1%. And on liquidity, we continue to maintain high liquidity buffers, which we would unwind over the next few quarters as our advances growth proceeds apace. Now, briefly talking about our results for the quarter, starting with asset quality and related provisioning. Our GNPA and NNPA as of the quarter end were 4.40% and 1.34%, trending lower Q on Q from 4.84% and 1.85% respectively. Gross slippages this quarter were lower at 619 crores, as against 766 crores. Adjusted for recoveries and upgrades, which continued to be strong, Net slippages this quarter were rupees 292 crores. Of the gross slippages in this quarter, 201 crores was in credit cards, 163 crores in microfinance, and 182 crores in the rest of retail. Slippages in wholesale were 73 crores. Our gross restructured advances stood at 1964 crores, down from 1998 crores as of December end. And our net restructure stood at 1614 crores as against 1746 crores as of December end. As mentioned earlier, we have taken adequate provisioning on MFI and unsecured retail restructured book. Provisions. We took total provisions on advances, which is NPA, restructured and standard asset, of 534 crores in this quarter, as against 482 crores last quarter. We had recoveries from written-off accounts of 142 crores. Net provision on advances, therefore, was 392 crores in this quarter. We've given a lot of detailed information on the provisioning in slide 22 of our presentation deck. Our provisioning bases the RBI guidelines and our internal policy for this quarter was 369 crores. Given that the SMA levels in microfinance have markedly dropped, bases which we had created the COVID overlay, we used the COVID-related provision towards specific provisions in the microfinance business, and we also increased the provisioning on the restructured book, primarily on the unsecured book, by 107 crores. As a result, coverage on our restructured microfinance and unsecured retail advances, ex-cards, has improved significantly, largely reflective of the LGD we are seeing currently. So in summary, we have taken 160 crores of extra provisioning over and above RBI and internal norms after netting of the COVID provisioning reversal. As a result, PCR is now 70.4%, as against 62.9% last quarter end. Operating performance. Overall advances grew 2% Y-on-Y and 3% sequentially. Retail advances declined 9% Y-on-Y, but grew 1% sequentially, whereas wholesale advances grew 18% Y-on-Y and 5% sequentially. Retail wholesale advance mix stood at approximately 52 to 48. Y-on-Y NII grew 25% and 12% sequentially to 1131 crores. Other income was 511 crores for this quarter. Retail was 77% of our core fee income. Y-on-Y total revenue was up 13% at 1643 crores. Our OPEX this quarter was 985 crores, primarily driven by cards, retail build-out, branches and technology. PPOP this quarter was at 657 crores and profit after tax was 198 crores for the quarter versus 156 crores in Q3 and 75 crores in Q4 2021. Now on to our deposits. Summarizing the quarter, year-on-year trends were healthy with total deposits growing 8%, CASA deposits growing at 20% and retail and small business deposits growing 13%. CASA ratio was 35.3%. Retail and small business deposit ratio was 38.9% as of March 31, 2022. Our liquidity levels continue to remain high with average LCR at 138% for the quarter, and it's trended up in the months of April and May. Our cost of deposits was essentially flat quarter on quarter at 4.75% in Q4. Lastly, on capital adequacy, our CAPAD ratio as of March end was 16.82, as I mentioned, with a CET increasing 45 basis points sequentially to 16.21. As I mentioned earlier, we are near closure on our Tier 2, which should add 1% to the overall CRAR. With this, we are comfortable on our capital position and don't envisage any need for capital in financial year 23. Outlook. On advances and growth, on advances, retail engines are now coming back to normalcy post-COVID, and we expect growth in retail to be in the mid to high 20s in financial year 23. This growth will be from cards, microfinance, housing loans, rural and vehicle finance, with an initial start in used cars with a digital marketplace. In wholesale, while we will focus on adding clients which give us good economics, Over the next few quarters, we also have the opportunity to rationalize some of the low-yielding book which we had primarily built up last year, which was liquidity parked in highly rated names. This would mean that the earnings quality of the book will improve. In fact, in the wholesale business, we're seeing a very strong traction across our client spectrum, and we think this could actually be a very, very strong year for wholesale bank. On an overall basis, therefore, we should see a 15 to 20% growth in advances in FY23, with a resultant higher growth in better earning assets. The ramp-up in earning advances in the first half would take NII total income and PPOP to more normalized levels in H2 of FY23. On deposits, as I mentioned, given the surplus liquidity we are carrying, we expect to modestly increase overall deposits. In fact, we probably maintain our CD ratio around 85 or just under that. Within this, however, we continue to improve the granularity of retail deposits, CASA, and small business deposits. Operating performance. Our cost increases will be from growth in retail assets, cards, microfinance, investments in our housing and rural vehicle business, increase in branches staff, and technology-related expenses. On asset quality, we expect credit costs to be markedly lower in FY23, having improved coverage on our existing NPAs as well as restructured advances, and we expect the trends in recovery from stress accounts across both wholesale and retail to continue apace. We are therefore targeting a cost of credit of around 2 to 2.25% in FY23. This, as you can acknowledge, will be less than 50% of the run rate of FY22. With that, I will now hand over to Harjeet to talk you through some details on the retail businesses for this quarter.
Thank you, Rajiv, and a very good evening to all. I will outline for you our Q4FY22 experience and how we are seeing things as we move onwards from here. Let me talk about advances and disbursements first. Advances declined by 9% year-on-year, but grew 1% sequentially. However, what is pertinent to note that we saw a year-on-year growth in advances in cards of 10%, home loans of 48%, and tractor loans over 600%, albeit on a low base. On the other hand, we did see a decline in micro banking of around 32% year-on-year due to our cautionary stand on the market and our enhanced provisioning, which led to lower net advances. And also a decline of around 25% in business loan segment, where the unsecured books, as part of our strategy, are being run off. We actually ran off around 1,500 crores of unsecured books in the last financial year. Disbursements, which started again from Q3 onwards across all business segments, picked up momentum in the fourth quarter, and we should see further pickup this year. For example, micro banking itself saw sequential disbursal growth of 25%. We do expect, therefore, the non-wholesale business advances to show significant growth of upwards of 25% in FY23. In fact, cards and microfinance would show a growth of upwards of 30%. Home loans would double, and the tractor finance book would grow 3.5 to 4 times of what it is today. How we are seeing things today? Markets are upbeat and are providing an opportunity for growth across all business segments. In urban markets, we are seeing healthy uptick in credit cards and home loans. In the business lending segment, the demand is back with the opening up of the economy, but one has to be careful in deciding which businesses to lend, depending on the leverage levels, the recovery post-COVID, and the performance through COVID. In rural markets, we see buoyancy in demand across microbanking, agri, and tractor loan segment. We should therefore see reasonable growth in FY23. Collection bucket resolution rates continue to be better than pre-COVID levels across all buckets in all retail business segments. This gives us confidence to now start scaling up our disbursal rates. Collection efficiency has seen a sharp improvement in microfinance. Overall collection efficiencies on the non-NPA book has improved from 83% in June to 94% in September to 98% in March. The book originated in FY21 and therefore not subject to any moratorium is running at collection efficiencies of 99.5% and gives us confidence that most markets are now stable and back to pre-COVID levels. As pointed out in our earlier commentary as well, West Bengal and Maharashtra continues to be challenging and hence have negligible share in our new disbursements. The new book accounts for 73% of our total microbanking advances, and this proportion is increasing every month. If I look at the non-NPA book, then the new book proportion is higher at about 85%. Slippages. As mentioned earlier, in overall retail, after a sharp reduction in slippages in Q4FY22 of around 45% over Q2, slippages further reduced by 16% over Q3. Total slippage in Q4FY22 were at 546 crores versus 648 crores in Q3. This is the third consecutive quarter of reductions. As guided in our calls earlier, we had expected slippages in half to FY22 to be less than half of that in H1 FY22, and this did happen. Half two slippages account for only a third of total slippages for the year, indicating that the worst is behind us. Further, recoveries and upgrades were much higher, resulting in a reduction of around 34% in net slippages post write-offs in Q4 over Q3. Card slippages were at normal levels at 1.5% in Q4. That is around 200 crores versus 248 crores in Q3. We expect a benign FY23 with total slippages in the region of around little less than 6%. Further, the card GNPA for FY22 was now down to 2.4%. In FY23, we expect the GNPA to be in the ballpark range of around 1.7%. And the credit costs for cards in FY23 are expected to be at historic lows, somewhere in the region of about 4 to 4.5%. While we saw a reduction in the core slippage run rate in other retail loans in Q4 over Q3, however, there was a one-off which we took, which was out of the implementation of the out-of-order criteria as defined by the regulator, which was to be calculated on a daily basis versus earlier, which was calculated on a quarterly basis. This did give us a one-time hit of 60 crores in slippage. A large part of this will get upgraded in Q1 FY23. Including this impact, slippages were slightly higher in the retail loans, ex cards and microfinance at about 172 crores in Q4 versus 140 crores in Q3. In micro banking, as indicated, we are seeing lower gross slippages across low gross slippages sequentially in Q4 of 163 crores versus 252 crores in Q3. And this was 375 crores in Q2. While these are still higher than normal. As I said earlier, collection efficiencies have shown significant improvement, and we are seeing these customers stabilize in their existing delinquency buckets. As indicated previously as well, recoveries happen towards the end of the loan tenures as these customers do not catch up on their missed EMIs and don't generally get upgraded or normalized. Now, in terms of business momentum, credit cards. After our ever highest card issuance of 6 lakh cards in Q3, largely on account of the higher pipelines post our MasterCard embargo on issuance in Q2, we issued 4.5 lakh cards in Q4 FY22. Retail spends in credit card also continue to show robust growth, and Q4 has seen a growth of 33% year on year. Q4 total spends were around 12,276 crores, again the highest ever, and slightly higher even than the festive Q3 FY22. And all this growth is coming from retail spends as we have negligible corporate cards portfolio. In micro banking, as mentioned earlier, we had started disbursements since the beginning of October, given collection efficiencies on e-book were upwards of 99%. Q4 disbursements were at about 1338 crores, with Feb and March clocking around 500 crores monthly disbursal. However, on 16th of March 22, RBI issued new directives for the microfinance segment, which has significant changes in terms of definition of the segment, assessment of household income and profile, introduction of income to installment cap of 50% to control indebtedness at a household level, and increasing transparency in terms of customer communication and documentation. We believe this is a step in the right direction and will be positive for the industry in the long term. And in terms of penetration of organized finance within the rural households, which would therefore result in increased cross-sell at a household level and reduce volatility and risk outcomes through controlled build-up of leverage. As of now, we are in the midst of making these changes in our processing and acceptance rules and technology. Since the implementation timeline for these new directives was 1st April 2022, we are currently not disbursing any new loans. We should be ready for disbursals in a couple of weeks. Business traction in secured business loans has also started to pick up, and we saw a bump up in disbursals in Q4 FY22. As mentioned earlier, we have moved to a much safer segment here as well. So while yields may be lower, this portfolio will be much more resilient in stress times than before. Our new business of home loans and tractor loans continues to grow along with the investment in infrastructure and distribution, and we saw significant increase in disbursal run rates in Q4FY22. While these portfolios will only start becoming meaningful in FY24, it is an important focus area for the bank towards building a secured book, and the positive traction is giving us confidence. I would now like to hand over back to Rajiv for his concluding remarks.
Thank you, Ajit. I will end our commentary reiterating some of the things we have done in this quarter and briefly touching upon our medium-term plans. As I mentioned on deposits, our position has returned to normalcy, and we continue to grow granular retail deposits. On asset quality, we have increased coverage on our existing NPAs as well as increased provisioning on our restructured book, specifically on unsecured. We are therefore well provided and are entering financial year 23 on a very strong footing. On an ongoing basis, therefore, given our mix of businesses, we expect a steady state credit cost of between 2 and 2.25%. We're planning for a 15 to 20% growth in the near term, of which we expect retail growth to be 25 to 30%, while in wholesale in the near term, we'll gradually run off the low-yielding book, but still will be able to increase the overall business across a wider set of clients. On an ongoing basis, therefore, overall earning assets, yields, etc., should see continuous improvement. Within retail, besides the cards and microfinance businesses, which will still be a large component, we are growing our rural, housing, vehicles, and business lending segments. Overall, on a 3-year basis, we do see the bank growing closer to 20% on a compounded basis across all segments. In wholesale, the focus will continue to be adding more clients in the corporate, mid-market, supply chain, government, and NBFC, and new economy areas. With this, we will now take questions. Thank you for your time.
Thanks very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Congratulations on a strong performance amidst all the challenges.
Mr. Agarwal, sorry to interrupt you. Please increase the volume of your device.
Is it any better now?
Yeah, Nitin, we can hear you. Go ahead, please.
Great. So, Rajiv, first question is we have seen back-to-back pretty sharp improvement in margins over the past 2 quarters. So how sustainable this is, and where do we see this trending now that we are talking to further, see a faster growth in the retail assets?
So, Nitin, I'll let Jaideep answer. There's a specific thing for this quarter. Let him answer that, and then we'll give you a sense of where we see NIMs for the balance of this year.
Yeah, so Nitin, in the past, he had mentioned that we not recognized interest income on our restructured book. We were advised that we will have to take it into income, and therefore we have done that. So that has added about 45 to 50 basis points. So on a normalized level, we will be back to 4.5 to 4.6% in the next quarter and thereafter, with a marginal increase after that. And therefore, we have obviously taken all of that and more into provisioning from the restructured book.
Okay. And second is on the fee side, fee income from cards, if I look at, the fee intensity is coming off every passing quarter. And even if I compare it to the pre-COVID levels also, then fee income as a percentage of spends has come down. So how do we see this?
Yeah, Nitin, so there is unfortunately a quirk there as well for this quarter. We have reversed approximately 50 crores of card fee income across late payment charge and over limit charges. This pertains to the COVID period, where interpretation issues resulted in us now reversing that charge. So if you adjust for about 50 crores, then it will be sequentially flattish in terms of card income.
Okay.
And this is just a one time, so this will not recur. I think this is something which we discussed with the regulator and the auditor, and we took it all in this quarter.
Okay. And lastly, on the restructured asset provision that we have made this quarter, now that we are guiding for a credit cost to decline to 2-quarter range, what is the collection efficiency in the restructured portfolio currently, and how much slippages are you building in from this portfolio?
So Nitin, not a large part of the restructured book, at least. So the largest part of our restructured book is in the retail side is secured loans. And I think about 10-15% of the book has come out of restructured book. And that performance is very encouraging right now. So we will not expect any out of the ordinary slippages on the secured book. And even if there are slippages, given the LTVs that we carry, and historically we've never lost the principal on the secured retail book. So therefore we are carrying 10% provisioning on that book, which we think is reasonably okay. On microfinance and unsecured, we have upped the provisioning quite significantly, and that should substantially reflect LGD, give or take.
Okay. Thanks.
And Nitin, sorry, there's a credit card item there which actually is more a technical issue. These are all performing customers who, from a technical reason, we had to classify them as restructured, but they're all performing.
Yeah. So on card, you have to keep in mind that this entire restructured book pertains to 2020. So if the loans are still live, which means they're all good, and accounts are still live, which means they're all good, and they're all paying.
And sorry, in this context, I also wanted to just clarify, we were asked this question in Q3 results. So the RBL inspection got completed and we have no reportable divergence. So the divergence number was barely single-digit growth, low single-digit growth.
Okay, that's good to know. Thanks so much and wish you all the best.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. So firstly, with respect to maybe the induction of the RBL director, and since now it's sometime long, so was it primarily with respect to the management transitioning, or there were other observations as well which has come in, say from the nominee of the RBI director? If you can highlight anything which has been there over the last 4 months.
Yeah. Kunal, as I mentioned in my Jan commentary, it is entirely transition. And as Jerry probably mentioned it, we've already gone through a regulatory, normal inspection. And barring that 50-odd crores, which is a one-time thing, there's been no other observation. And I don't think there's anything more than that. Otherwise, it would have to be reflected in our financials for FY22. So that much I can state.
Sure. So this 50-odd crores is what you are highlighting in terms of the daily recognition one, or maybe the fee income, or the fee income reversal?
This is the fee income reversal, correct.
Yeah.
Okay. Got it. Yeah. And secondly, with respect to OPEX, so again, I think the margin trajectory was quite strong, but still cost to income is at around about 60-odd%.
Yeah, Kunal, I think we will be in this ballpark for a while till we if you look at our last 2 to 3 years, we have interest earning book has actually come down from maybe 59,000 crores to 54,000 crores on a daily average basis. So till the time we grow our businesses back, which will take us maybe a couple of quarters, we will have this challenge where costs have to grow because we are investing in branches, technology, and so on and so forth. Retail asset business is coming back where costs are upfronted. So till the time there is somewhat of an increase in the interest earning book, which we will expect the next couple of quarters to give us, this will remain in this range at least for 2 to 3 quarters.
Okay, so that investments both at the employee side, I think again the cost was higher quarter on quarter, and even on the operating side, and you highlighted maybe in terms of the retail build out as well as technology that is continuing. So that will still. So any guidance on that part? Maybe you had highlighted with respect to growth, credit cost, etc. but how should we look at the cost line item?
Yeah, I think, Kunal, suffice it to say, I think you should assume in the same ballpark. Also, maybe when we discuss June, we'll give you a little bit more analysis at segment level so that you understand, because the balance sheet structure, if you can understand, credit cards has come back faster and stronger. Microfinance, we started in March and now 30, 40 days of hiatus, but it will come back. Retail loans are coming back. So there is a need to understand at a segmental level what is driving the overall economics of the business, which then translates back to OPEX ratios, etc. So I think we give you a little bit more flavor, but I don't think for right now we are continuing investment in these areas which you mentioned, and those will eventually lead to better economics for the bank. And we will get our retail wholesale mix back to 65-35 in the not too distant future.
Sure. And one last question with respect to the when we look at it, the segmental breakup of slippages. So in fact, in the absolute term, the business loans, it's still inching up quarter on quarter. And even in terms of the growth, that's the only segment wherein we have again seen 7% quarter on quarter decline. So how should we look at this particular segment? What would be our maybe the near-term strategy out there, and could this throw in a relatively higher stress going forward, given maybe the input cost and everything is going up? So would there be more problems with respect to the business loans?
So Kunal, on slippages, as Harjeet mentioned, we implemented the new RBL circular which came in effective November 12th, and that did result in a increase by about 60-65 crores on slippages on retail. A good part of that we expect to be upgraded next quarter. This is a fairly stringent criteria for OD cases, not term loans, but OD cases. So if you adjust for that, we will be sequentially lower. I will let Harjeet comment on the business growth.
Yeah, on the business growth, as I said, that we've done two things. One, the segment itself has changed, and as more and more months pass, you're getting more and more clarity in terms of the leverage levels of these customers which they've taken during the last 1 year or as they came out of COVID. I expect business loans to grow, core business loans to grow at around close to between 15 to 18% in FY23. But we need to keep in mind that when you look at the aggregates, we are running off an unsecured book. We ran off about 1,500 crores last year, and therefore that does mute the growth which we are seeing. But otherwise, that's how we look at this business.
Sure. Okay. Yeah. All the best. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. Next question is from the line of Rupesh Tatia from Intelsense Capital. Please go ahead.
Hello, sir. Can you hear me?
Yes,
we can hear you, Rupesh.
Okay. Thank you for the opportunity, sir, and congratulations for good set of numbers and fairly strong commentary. My first question, sir, is in between there was this news item that NBFCs, can issue credit cards now. I mean, obviously they have to go to RBL and take approval and all that. So, with respect to Bajaj, do you have any comment to offer?
Rupesh, I don't think we see any challenges for our growth, either from Bajaj or otherwise. I have no idea on what the final regulatory approval structure will be, because we've seen this circular discussion come once in every 12-15 months. Obviously, with Bajaj, our plans are very, very set, not just for this year, but for the next 3-4 years. And I don't think those plans will basically be rolled back in any form, as far as we are concerned. Other than that, we don't deal with any other NBFC, so we are pretty good there. Ajit, anything more?
No, that's it. So, I mean, this circular is the same as what it was for the last 3-4 years. There's no change in the circular.
Okay. And then so in general, in qualitative aspects, can you talk about non-Bajaj, credit card organization, in terms of acquisition engine, in terms of credit cost, what kind of profitability you make. If you can just give some color, maybe with respect to Bajaj portfolio and also maybe with respect to industry.
Yeah, so we did mention that both portfolios actually on a credit cost basis and the ROA basis, both portfolios are fairly similar, give or take 25 basis points, 30 basis points here and there. We are obviously now, over the last 2 quarters, I would say, putting in a lot of efforts to grow our non-Bajaj book, especially around our co-brands around Zomato and Bank Bazaar and Paisa Bazaar, which have started to pick up fairly well. Our spend levels on the non-Bajaj book are, I would say, almost double that of the Bajaj book. And as a result, if you look at it, our portfolio distribution, despite the skew in terms of number of cards, is roughly 50-50. 45% is non-Bajaj and 55% is the Bajaj portfolio overall. So from a earning potential, ROA potential, fairly similar. But obviously the dynamics are very different. Bajaj portfolios are more widely spread across almost 400-500 cities and towns versus non-Bajaj book, which is close to about 80-90 towns.
Okay. That is good to hear, sir. My second question, sir, is historically, I mean, there is a problem with the bank, which is with respect to wholesale banking, because the spreads in wholesale banking, at least by my calculation, are 75 to 100 bips, and it is an extremely competitive space. And there is always this fear of large slippages across the cycle. This is a structural issue, and being a small bank, we have a slightly higher cost of funds, so obviously we have a slight disadvantage. So how do you address this? How do you take this 75 to 100 bips spread to let's say 125 or 150, and how can you assure us that across cycle now we'll make a good ROA relatively compared to industry in wholesale book?
Rubik, that's a fair question, and I think we've been sharing some of the work we're doing, but let me just summarize it. So post 2019, we basically put a very firm underwriting structure, which reflected not just our learnings of several years, but we had a few relationships where I think the challenge was concentration and not maybe initially the choice. I think those were really what hurt us. We put a very strong regime of underwriting, target operating model in terms of concentration, and that helped us during COVID. Actually, if you see our COVID performance in wholesale banking has been extremely satisfactory because we'd already implemented that. But to your point, and I also alluded to the fact that because of lack of credit growth between 2021 and 20 and 21, a lot of our wholesale deployment went into high quality, low yielding borrowers, where obviously you will not make money given our cost of funds. So gradually over the last 2 quarters, we've seen growth come back, and my guess is that we will continue adding more and more customers in the mid market, some in the corporate, NBFC, new economy. We have got 7 or 8 subgroups, Rupesh, which operate under the overall wholesale banking. And besides the NII on advances, which is an important part, I think we do a lot of work on FX, trade, cash management, digital services, which actually adds a lot more to the economics of the business. So, as I mentioned to you, that we will not hesitate in paring down some of the low-yielding, exposures over the next 12-18 months, and start filling them in with the mid-market and the other segments, which will help us improve the overall economics. Long term, I think you will see our book as the retail growth continues apace now. We will get into a 1/3, 2/3 structure, but 1/3 will be more granular, a lot more around trade flows, transaction flows, supply chain, with a lot of deposits and cash management thrown in, which we're already doing a lot of. So that's the only way you will juice up the economics of the wholesale business. But that's a strategy which got interrupted in 2019. Obviously, 20 and 21, because of COVID, we were extremely conservative, and now we are gradually opening up, and I think this will continue reflecting in the overall business we are doing.
Okay. Thank you for that. So one just small follow-up there. I mean, I am more interested in the qualitative, aspects of the business. So you're focusing on mid-market and let's say also MSME. So in terms of, employee talent, can you talk about it? Can you talk about recovery? What sort of, new to credit or single bank relationship or two bank relationship accounts in these, small accounts? Can you just, give some qualitative flavor? What has changed in last 2 years there?
Yeah. So I think invariably in most credits we will not be the single lender. I mean, so that I think, pretty much if it's a reasonable credit, you at least have 3 or 4, if not more. So, that's, I think, one thing I'll say upfront. I think in terms of the opportunity available for us, it's fairly large. I mean, we are a very, very tiny part of even the narrow segment I've highlighted to you. Now, I think what is important is that you have very strong coverage guys in the front lines, which we have enough of, and we've added a lot of youngsters over the last 1 year, which are now being blooded in terms of taking junior relationship manager status. Strong on credit. In fact, starting with our target operating model implementation, our credit structures have become very robust, where basically we are pre-identifying a lot of credits we want to do business with and heading to the market with something in our hand before we, start prospecting. And I think very, very rigorous follow-up from an early warning system, from a relationship ROA perspective, and over a time period, we have to ensure that the credit and the liquidity allocation to this segment starts making returns. So all of these things are now being almost enshrined. Obviously, we were working in an environment where growth was not there. Now growth is coming back. So some of these things are being implemented and we are seeing early signs of success. So for instance, in Q3, we acquired between 80 to 90 new customers in wholesale bank. And I think in this quarter as well, while we had our other challenges, but we actually had almost another 40 to 50 new clients acquired in the wholesale segment. And I can tell you that is the most exciting part outside of the asset levels of wholesale bank, which, everybody looks at, that how many new customers we are acquiring across the spectrum. We are one of the top 2 or 3 new economy bankers where the credit deposit ratio perhaps is more like 5 to 10%. We do a lot in deposits, trade, foreign exchange, salary accounts. In the NBFC segment also, we have a decent share in cash management. MNC also, there's a lot of sub-segments which are not exactly asset intensive and where you can actually improve your overall economics. Obviously, at the very top end, AA and up credits, you will never make money, which is what I was suggesting that we will run down over the next 12-15 months in terms of a book we built because of liquidity reasons.
Okay, that is good to know, sir. Focus on the business economics. My last question is data-giving question. With this 2/3, 1/3 retail wholesale split, what kind of gross slippages do we see in a normalized environment?
Yeah, so I don't know if I can comment right away, but I think a model cost of credit for the portfolio should be in the 2-ish range from a long-term perspective. And the only reason it will be 2 is because we've got cards and microfinance, which, by their very nature will be on the higher end of the credit curve, higher end of the cost of credit curve. Homes and business lab, which Harjeet talked about, where we're moving to the safer end, will be lower. Wholesale will try to push lower. And all the others we are doing we will have 3 or 4 more segments like rural vehicles, used cars, while they will be a little higher on a percentage basis, but the overall size of that contribution will be, it won't be dramatically high. So I think 2 to 2.25% over a life cycle of this business evolution should be the model cost of credit for us.
Okay. Thank you so much, sir, answering my questions, and best of luck.
Thank you, Rupesh.
Thank you. The next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Good evening, and thank you for the opportunity. Harjeet, first question on microfinance. You mentioned the hiatus because of RBI circular. Can you please elaborate what part of the circular made you do that, and what is it exactly that you're changing in the MFI business?
Yeah, so I think the core itself, in terms of assessment of credit, has changed. Earlier, assessment was done basis the borrower only, and hence you would take the obligations of the borrower and be in a position to decide the credit and disburse the loan. Today, what has changed is that you need to take a household income as well as the household obligation, which means I need to take the spouse, and if there are children which are unmarried, their obligations, and then also their income levels, and then apply that and put a income to installment ratio. Now that means multiple hits to the bureau, which then needs to be factored in before you are giving this. I think this is the single biggest change which one needs to get right before one goes ahead and does this, and which is where, and these things we believe cannot be done on a manual basis, because you end up disbursing about 150 to 200,000 loans a month, and hence hopefully we are in the fag end of UAT testing. In a week's time or so, we should be live with it.
And just to be clear,
Sorry. But I just add, I think the other important thing is, while I think this is a necessary build-out investment, the collateral benefits of putting a robust system at a household level will give us more opportunities with the household, especially the household above a certain income level beyond microfinance, which today, because it's a very simplified operating model, we are not able to capture. So those are things which obviously will take a little while, but that's our expectation from a medium-term perspective. So please go ahead.
Okay. And just to be clear, every loan given after 1st April has to be compliant with this new norms, right? So this is there's no grandfathering or anything. Okay.
No, that's correct. That's correct.
Okay. Moving on to cards, I mean, we discussed the card circular. So besides the NBFC, there were other parts of the circular, including, data sharing for co-branded cards, etc. So the rest of that circular, how do you think that impacts any part of the card business for you? And then your comments on the broader industry as well, the way card business is being run today.
Yeah, so the way I see it is, from a data sharing point of view, I think we were fairly okay even before the circular, because we don't share data with any of our partners, and if we are showing the cardholder their credentials on, let's say, the partner app, then these are all direct SDKs and data is in our environment. So while they just see it on the app, the data is never available to the partner. So I think we are okay from that point of view. I think where the changes are coming is more in terms of things like transparency. There was a big talk about activation of cards, which hopefully we're getting a little more clarity with engagement with RBI. I think as an industry body, we're doing that as to what is meant by an active card, because the circular says that in 30 days, if the card is not active, then you have to block it. And cards which have not been active for 12 months, you have to close. And the cards which you block in 30 days, if they don't get activated in the next 7 days, then you have to close. So they're pretty, some of those things are, I think, big changes. There are some accounting level changes which need to get done. So there is engagement as of now going on with the industry. You will see some element of, I would say, maybe fee reduction as a business. For example, if over limit is not allowed, then over limit fee will not happen. One has to start building up interest rates from grounds up. So those are some of the things which have been managed in the circular. So we'll see how things are going. So as of now, we're in the phase where we are engaging as an industry body with RBI, and I think RBI has been fairly open in terms of discussing this. So let's see how it comes out. But yeah, this time the circular is more prescriptive, I would say, in nature.
So the 12-month rule, if it is implemented as it stands now, do you think the number of outstanding cards can decline meaningfully at the industry level, not only specifically for RBI?
Dramatically.
Dramatically, right? Yeah, that's what I thought.
Yeah. So we do a more conservative approach because we actually, if the card holder is not active, we kind of attract them or close their account, but that's not the industry practice. We're also not a benchmark because we are fairly young in the card industry. I think people have been there for very long, and therefore carry cards for very long, and therefore would have a far larger base which is not active. Now, the definition of active is being discussed with RBL. So let's see. It need not be only.
So on that point, when you say when card is not active for you, how do you define active?
Yeah. So today, when we say card is not active, when we close cards after 12 months not active means the card is not spent anything.
Okay, understood.
So,
Right.
so we take it in that spirit. But I think there is a discussion that any customer-initiated action need not only be spent, should be treated as activation.
Okay, all right. Moving quickly to liabilities, can you share any data around the number of retail accounts, SA or TD? Because for this particular quarter, the difference between average CASA and period end CASA is the highest that we've seen in a very long time.
Yeah.
So Manish, so on average, and I think the issue obviously was that we lost on December 25th, and subsequent to that for a couple of weeks. So obviously averages for this quarter would be lower because of the impact, and the build out happened subsequent to let's say third, fourth week of Jan, and now it's back to where some semblance of normalcy, but obviously it became back ended. So that is the reason why average CASA is lower. It will begin to normalize by the next quarter.
And then for new acquisition numbers, the number is actually much higher than ever before. Even in the month of December, what we were doing, we are doing about 15 to 20% higher than that now. Both on in terms of CASA accounts as well as granular time deposit accounts as well.
All right. The other question is that given that we are in a rising rate environment and probably a pretty steep rising rate environment, what's your approach going to be on the liability side? I mean, between TD and SA rates, how are you thinking about changing those rates?
So Manish, we will be lazy to increase clearly because we are on the higher side. So this will be an opportunity to narrow the gap by either cutting less than what we were earlier planning to, or clearly not raising on the SA side at least. So that's one, and I think the rising rate environment also benefits in terms of being able to reprice a lot of the loans, both not necessarily linked to external benchmarks, but also otherwise, given the competitive dynamics will also move. If you notice, we've already hearing larger private sector banks moving materially up in terms of new business, both wholesale and retail, on rates.
Yeah. And for you, the entire wholesale book plus home loan in retail would be floating, right?
Yeah, we will pretty much only have realistically the cards and microfinance book, which is fixed rate. Almost everything else materially would be floating.
Okay, sure. Sorry, one last question to Harjit. Harjit, you mentioned that on a value basis, the card split between Bajaj and non-Bajaj would be about 55-45. But what would be your success in terms of cross-sell between Bajaj and non-Bajaj, especially on the liability side? Is it better in one channel versus the other?
No, we haven't really done much. We had done a pilot where we had opened about close to 80,000 accounts and then left it there because we were still figuring out how to get the balances going. Well, it's easy to open the account because it's digital in nature. The customer just needs to consent, but the issue is to start getting the customer to use it. I think that because of COVID was something which we had left aside. We'll have to start looking at it again in FY23.
Got it. Those are my questions. Thank you very much.
Thanks.
Thank you. The next question is from the line of Mahesh MB from Kotak Securities. Please go ahead.
Yes, good evening. Just a couple of questions. One is, first of all, let me just ask maybe this question. In the consolidated and standalone numbers, there seems to be a bit of a difference. It seems to be a bit higher this quarter.
Sorry, Mahesh, we can't hear you clearly.
So the difference between consolidated and standalone, the number seems to be quite high.
Yeah. We made a loss of approximately 90 crores in our subsidiary because their earnings are basically interest earning book, and we went slow in microfinance, as you know, and therefore the subsidiary unfortunately also had to kind of be in a situation where the earnings fell, but the cost did not fall as much.
But anyway, because So some of it are just kind of, so some of it is just an OPEX putting the subsidy and income, right? What goes with negative income?
No. So see, our payout to all BCs, including the subsidiary, is on the interest earning book. Now, we ourselves went cautious, so naturally the subsidiary unfortunately does not have the ability to do business with other banks, right? So they are dependent on us in terms of business growth. And if we became risk averse post-COVID for the right reasons, naturally the business, the interest earning AUM of the subsidiary on which they earn fees from us fell. And therefore they became suboptimal in terms of their branch network versus the book they were dealing with.
Okay. Second one is on the credit cost. And again, you kind of indicated about 2%. So when you go back to the commentary that you guys have made, the wholesale seems to be reasonably healthy. Has this been talking about good recovery on?
This is the operator. So please use the handset mode. The audio is not clear from your line.
Yeah. Okay. Harjeet has kind of indicated that the credit cards should be reasonably at about historical lows. MFI doesn't seem to be a big issue now. So where is the 2% coming from? Or is it just that you guys are looking at it from an outside edge?
No, so credit cost in FY23 will still be between 4.5%. Credit costs normally are in the region of about 5.5%. FY23 will be an exceptionally low year for two reasons. One, the recoveries will still kick in. The second is that the bad book was almost washed off completely, and therefore it will take time for those things to build. And some of the factors is the revolve rates are also extremely low. So FY23, you will see a lower credit cost, but it will still be between 4.5%.
Okay.
Thank you. The line for the current participant has got disconnected. We'll move on to the next question from the line of Abhishek Murarka from HSBC. Please go ahead.
Hello.
Yeah, Abhishek, go ahead, please.
Yeah, hi. Thanks. So thanks for taking the question. Actually, my question is on credit cost again. So I believe I heard that you said that retail slippage would be roughly about 6% this year. And on the retail, I would assume at least 60-70% coverage. So you would have to provide roughly about 3.5-4% on roughly half the book that is retail. So approximately 2% provision would simply come out of the retail book by this math. So are you factoring in very, very low slippage and therefore a very low credit cost on the wholesale side, or are you factoring in any reversals? How are you getting to that too?
No, so Abhishek, part of the answer also lies in recovery, right? We are carrying a largish NPA book, while very heavily provided, will on a good day should also be giving back more than what we provided, at least in certain segments.
Okay, so your 2.5 is net of recoveries.
Yeah, credit cost is always net of recoveries.
Yeah, I mean, I'm just trying to test the.
Not only cards.
It's a net of recoveries of cards only.
No, for everything, yeah. Yeah, go ahead.
Okay, sure. My second question is on MFI. Would you be looking at higher lending yields over there? I mean, after the new regulations, does that gives you anyway a little more room, because some of the market participants on the NBFC side would also look at increasing rates. So how are you thinking about that?
Yeah, so one of the things in the regulation is that you need to build up your justification for interest rate grounds up.
Hello.
And therefore we would see that our current yields, I think, minus about 100 basis points is what we will be at. Can you hear me, Abhishek? Hello?
This is the operator, so we can hear you.
Okay,
I don't think Abhishek can hear me.
Yeah, sorry, I couldn't hear you for a bit.
Okay. So what I was saying was that one of the pieces in the guidelines says that now you need to be able to build up your interest rate which you charge to the customer grounds up, in the sense from your cost of funds upwards. And therefore, when we are implementing that, we would be actually seeing a cut in our yields being or interest rates being offered to the customer by about 100 basis points than where we are today. So for us, you will see a little bit of a drop. What you are referring to is some of the MFIs which were governed by the 10.5% kind of cap. They might be increasing, but I think from the bank side, at least for us, you will see a little bit of a drop.
So what will be the rate right now?
Today, it ranges between 25 to 26%.
Oh, okay, sure. Yeah, understood. And just another question on cards. So, a couple of entities now, including yours, have shown that, the share of cards in self-employed and tier 3 and all of that is going up. So just what is really happening in the industry? Is it that the tier 1 centers salaried is completely saturated and therefore you're going deeper? Or what's really happening in terms of the customer profile?
Yeah, so see, the generic trend is that the leverage levels in your tier 3 cities are far lower. And therefore, that is a segment you would want to target to be able to bring into the credit card fold. Now, it's always been a challenge of being able to get the scale in tier 3 cities. And I think that was the reason why the concentration was largely around the tier 1, tier 2 cities, and therefore most of us were issuing cards to the same customer. And you had average about 2 or 2.5 cards per person which was running. But I think over this period, what has started happening is, one, as some of the larger banks have started getting into their liability base deeper down into smaller tier cities. And the second is this entire piece around shift to e-commerce, and therefore in partnership with some of the e-commerce players' ability to be able to now enter into smaller cities without actually investing too much in terms of distribution infrastructure there is enabling tier 3 card penetration to go up. That is the reason why across the industry you're seeing tier 3 go up. And it is also as of now proving to be better credit. Spends though are lower than the tier 1, tier 2. Okay.
So for you, how is the sourcing coming? Through your co-branded? Because you said co-branded is not so widespread. For us,
tier 3 is largely coming through the Bajaj partnership.
Okay. And what is the ability to collect there? So that anyway collection is done by Bajaj, so that's okay.
Yeah, so we have a dedicated collection infrastructure which does the cards collection, which is independent of Bajaj's own collection infrastructure. So they've created a separate independent cards collection infrastructure for us in these cities.
Okay. Sure, perfect. Those were my questions. Thanks so much.
Thank you.
All the best.
Thank you. The next question is from the line of Rohan Mandora from Equirus. Please go ahead.
So thanks for the opportunity. So just wanted to check, is there any update on timelines with respect to the MD and CEO? Where is the process right now on that?
Rohan, Rajiv here. I think it's in the final leg. So maybe, I don't know the timelines. Obviously, this is with the regulator now. So it should be, soon, but I cannot give a timeline. But that's where it stands.
Sure. Secondly, if you look at the presentation data, the Q4FY22 numbers with respect to core fee have been restated. So is that restatement primarily because of the same thing that you explained on credit cards? Or is there something else there?
No, Rohan, that restatement is actually also, if you notice, will be on cost side. So there was a netting issue which, typically there are certain costs which get netted where it is directly related to income. So there was an approximate 35 crores which got netted, which is why there is a equivalent difference in cost. That's got nothing to do with the reversal that we talk about in this quarter.
Sure, sir. And so, lastly, what is the PSL level for the bank? Are we PSL surplus right now?
No, we would be falling short by about 4 to 5%.
4 to 5%, okay. So if you can just share what is the rates on the PSLCs right now, and given the fact that HDFC with the merger may look to aggressively acquire bills, how do we expect the market to evolve there?
So we don't buy too much of PSLC. We end up being somewhat short with PSLC prices also fluctuate. So we have bought some this year. It starts being high in Q1 and then it comes quite substantially down. But one of the reasons why we were a little short this time was also because of the MFI business being much lower. So this should at least partly improve automatically next year.
Sure, sir. And so lastly, if you can just share what's the tech spend as a percentage of total OPEX?
Yeah, about 7 to 8%.
Okay, sir.
Only OPEX. Only CAPEX, it will be different.
So if you were to include both of them?
Yeah, but then I can't express that in percentages because in the denominator will be OPEX, but that should be double, so about 15 to 16%.
If you take a depreciation, then you're more like 9 to 10%. If you include the depreciation, which is the right way to look at it.
Sure, sir, sure. Thanks a lot.
Thank you. The next question is from the line of Jitu Punjabi from EM Capital Advisors. Please go ahead.
Hi, Rajiv. I had two questions. Part of it which got asked was when does we have clarity on MD and new MD and or who's the root person will be. The linked question here is with an RBI observer now on the board. Does it in any way curtail you guys from doing anything? Are there any restrictions that are at play and what level of freedom gets curtailed to that?
No, Jitu, in fact, there's no restriction or curtailment or guidance on our business. I think as a normal director, they get involved in all reviews and participate in general discussions. And actually, the way I see it, and maybe it'll be tough for me to convince you, but actually there's been no difference. In fact, we've got a much better engagement with the regulator across the board, as well as an understanding both sides of what needs to be up. These are normal, general, day-to-day, things which happen to most banks. So it's not just us. So I don't see that as an issue at all.
Okay. And a second question, if I may ask, I mean, while technically you're termed interim MD or whatever the terminology is, but you're effectively running the bank. Are there long-term investments and longer-term thinking that goes out of play while running the bank, or is it more just tactical and kind of keeping the shop running while? So pardon me for asking this, but I just thought it's important to get clarity on this.
Absolutely right. Look, we have all of us have been around for years, and
correct, yeah.
Also understands that. So we are taking long-term decisions, and some of these decisions have been in place not just now, a year ago, a year and a half ago. I don't think there's any changes which have been necessitated by this situation or the fact that I'm an interim. I mean, I take calls for 3 to 5 years along with my colleagues. So I don't think we want to, either shortchange our stakeholders or ourselves by taking more immediate calls. And there's an active process with the board. We have processes on annual operating plans, capital allocation. And actually, if you go back, Jitu, our conversation at the peak of COVID-2, we had outlined certain principles, which I reiterated in Jan, which was quite fresh after the event. We are proceeding exactly on that, and obviously preparing a bank which has a lot more robust cost of credit model, predictability, and an earnings profile which can be defended in most market environments. The challenge of COVID actually taught us that, and I think one of the conversations with Rupesh was on wholesale, which was already implemented and is now being vigorously pursued. So nothing is short term. In fact, if you see our provisioning, if it was short term, then I wouldn't have been doing a lot of provisioning in this quarter. If it was just to mention that, I'm an interim in this year. So we've taken a long-term view because we want FY23 and beyond to be really a solid year for our troops, for our positioning in the market, because we have been a little bit defensive last 2 years, so I don't think we should be defensive anymore. as long as it's disciplined businesses, we have many businesses right now. We want to take the right calls, and these calls are taken with the relevant level of disclosure, discussion, and analysis across the board.
Okay, super. Thanks. All the best, guys. Thank you so much, Rajiv.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi. Thanks a lot, and congratulations for actually seeming to be a turnaround quarter. My question is that when you are giving the guidance of 2% or 2.2% credit cost, what PCR you are assuming for the end FY23?
We should be broadly in the 65 to 70% range. It is very unlikely we will want to go below 65.
Right. So that is one. Second is that on the other income and fee side, are there any other initiatives to actually improve the fee income growth?
See, I think the business franchise growth as it is coming back will naturally carry the fee momentum as well. So when you look at new business across retail and wholesale, which were subdued for multiple reasons over the last 12-18 months, as that engine starts coming, the fee income engine will also, therefore, in parallel, come back. And as Harjeet was mentioning, cards, for example, is a very high fee business. So when the growth momentum comes, so last year we grew only by 10%. So assuming we grow by 20-25%, the fee income should, for example, reflect that growth in that business. So I think we've been constrained by growth given the. I think that now is really turning around, and therefore all levels of income, all lines of income should start firing.
Right. So last question from my side. Other than the MFI yield compression that will happen a little bit, other than that, the spread and NIM outlook, if you could share, that would be helpful. Thanks.
Yeah. So as I mentioned, this quarter we had approximately 50 basis points excess, so we should be in the 4.5% range for the next couple of quarters, maybe next quarter, and then it should start improving because the mix between retail wholesale should again start favoring retail. And second, as Rajiv had alluded before, even within wholesale, there will be a progressive realignment between low yielding assets versus more commercially logical yielding assets. And therefore, I would be surprised if we don't have NIM expansion as we go along the year.
So, and Pranav, sorry, I was just about to chime in when you asked your last question. Just so that you know, from an other income perspective, we had the best year in trade FX. Right. In spite of having a tough COVID, this was the best year, and while I will not share numbers, almost 50% plus came from retail, and the other 50% came from wholesale, which is what I was mentioning to Rupesh, that we have a very large franchise in trade FX and related areas from a variety of segments. So, see, these are all functions of the underlying economic activity, and are obviously, what is our target addressable market and how much are we engaging with them. This is an area which will continue growing, Pranav, and this needs, very strong execution, very strong, turnaround times, and this is an area where, few private sector banks score very highly. And I think those are the areas we are focusing on. 5 years ago, retail was almost zero in that area. Today, it's about 50%. So as a branch catchment, customer catchment improves in retail, and that becomes just almost like a regular, kind of income for forever.
Right. That's great to hear. Thanks a lot.
Thank you. Ladies and gentlemen, we now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com. On behalf of RBL Bank Limited, we thank you for joining us this evening. You may now disconnect your lines.
Thank you so much.
Thank you.